Greetings, my name is Kevin Matthews, and this is our first live stream from Beta Solution CPA, and so I'd like to invite you guys all here. Actually, I'm going to go ahead and take off that microphone. I was doing some sound testing before I got ready for this. So basically what we're looking at here is that we're going to talk about the CARES Act and how it applies to each of our, both our clients, of course, very important, and then of course the most important thing is that we also want any prospective clients. And so this was actually a bill that was passed as a result of the COVID pandemic in late in March. And so what ended up happening is that there were several provisions that got put up. And so the first thing that came up, of course, was the recovery rebates that everybody's been talking about. And so the recovery rebates that we're talking about being passed, which they actually did pass, is that they basically made it to where there's $1,200 per taxpayer. So if you had a single return or a had a household return, the individual would get $1,200, and then of course it was married filing joint, be $2,400, one for each spouse. And so what ended up happening is, in addition to that, I'm sorry, and actually another part of that is there was also a $500 amount paid per child. Now, what they did, because the way that it was actually set up, they know that most people hadn't filed their tax returns. Some had, some hadn't. And so what they said is, look, we're going to refer to the 2019 tax returns. However, if you haven't filed your 2019s, we're going to file your 2018s, which actually caused a little bit of a problem for us because there were several clients who were getting ready to file, and they looked at it and they said, hey, whoa, I just got a major pay raise in 2019. I'd like to hold off a little bit. And so we were actually helping a lot of our clients with that. In fact, when we started doing the shutdown here at Beta Solutions, we actually shut down the office on April 1st. And we sent all our employees home. Now, I'm broadcasting from our office locations, and so what ended up happening is we sent the employees home. I went ahead and I still came into work, and still trying to crank out as many tax returns as we can. The problem is, for us personally, we had to reach out to many of our clients that we kind of said, hey, wait a minute, 2018 looks like you're going to qualify. Let's hold off on filing your tax returns so we got past this whole thing. You get your money, and then we can finalize your 2019s. And so that's where we're at with some of our clients. Now, some of our clients, they weren't going to qualify under either year, so we just went ahead and just made a decision whether we wanted to file them immediately at that point or not. And then there were some other people who just weren't ready anyways, and so but we just put them on the delay until they got all their stuff turned in. But basically, getting back to the recovery payments, what ended up happening is that you would get the recovery payments if your income was under a certain threshold. And so in order to get the full credit, as a single person, you had to be under $75,000. As a head of household, you had to be under $112,500. And then as a married filing joint person, you had to be under $150,000. Now, if you were over that, but not too far over it, you started going through a phase out. So it's kind of, it would basically phased out until it got to zero. And of course, I believe it was $99,000 for single people and then $198,000 for married filing joint. The goal was to get the money into the taxpayer as fast as possible, so the IRS would say, hey, if you filed with us and gave us your bank account information, we're going to give this to you through your bank account, provided that you had done in 2018 or 2019. Now, what this actually presented a little bit of a problem for some of our clients. What happened is that some of our clients ended up having a balance due, so they didn't give their bank account information, or some of our clients still, they didn't want to provide their bank account information, and instead what they did is they would ask for a paper check. Those individuals could go to the website that the IRS provided, which they did, and many of our clients, they succeeded with this, but there were several of our clients who were not able to succeed with it, just because of the fact there was just, for some reasons, there were problems on the IRS's issue. Now, normally what we would do, they'd call me, say, Kevin, we got a problem, and I'd call the IRS and we get it resolved. The bad news is the IRS shut down, and as a result of them shutting down, they essentially what ended up happening is there's no way for us to be able to contact them. So that actually kind of caused a little bit of a problem this year. I hope it didn't, I hope it didn't cause too much of an issue for anybody out there. But the whole IRS shutting down and not providing live support to anybody, let alone tax professionals has created a lot of disruptions, but I would say a good chunk of the disruptions was created in this tax credit. So, if you didn't file a return in 2018 and you weren't going to file one in 2019, there was a website you could go to. This was a very common thing that we noticed with veterans. We also noticed this with Social Security recipients who maybe didn't have to file a tax return in the past. They had a website they could go to and say, hey, upload your information, we'll go ahead and get it taken care of. Now, some of you who didn't get the payment because of some snafus or whatever from the IRS, you haven't lost the payment completely. What's going to end up happening is that in 2021, there's going to be a reconciliation process that's going to take place. Now, how that reconciliation process is going to work, we don't know the answer to that right now. Right now, I think the way that they're probably going to end up doing it is they'll say, hey, we're going to look at your 2018s and your 2019s, and if you qualify, we'll give you the payment back. Now, the question of the day is, are they going to take a look at your 2018s and your 2019s, take the better of the both years and give you a payment as a result of it? Or are they just going to say, hey, we're going to look at your 2018s, 2019s. If you didn't qualify under 2019, you were probably not going to give you a payment. At this point, I don't know the answer to that. And quite frankly, I don't necessarily know that the IRS knows the answer to that either, because they're still trying to, they're more focused on trying to catch up on everything that's happened up until this point, not really looking too far into the future, unfortunately. Hopefully that'll get changed here soon, and then we can get that moving forward. Another provision that ended up happening as a result of this, they did a waiver of the 10% penalty for distributions, early distributions from qualified retirement plans like 401ks, 403bs, traditional IRAs, Roth IRAs. If you're under the age of 59 and a half and you decide to take out from one of these plans, you would normally pay a penalty, but they've gone ahead and waived that for this year. So I think that if you're in one of those circumstances that you said, hey, I've got this 401k, I just got laid off from my job, I need to pay bills in order to be able to survive stuff, I need to have money pulled out. And so you can actually do that, pull out the money, and as a result of that, you can live off of it if you absolutely have to. My recommendation is, before you do that, you want to talk to me, or you want to talk to your tax professional, or you want to also talk to your financial planner, because they understand what you're going through. And look, some people say, well, if I reach out to my financial planner, they're not going to want to sell. Well, hold on a second. This is exactly why they live. Okay, they live to help you get through all of the problems that we have in our financial circumstances, and so this is definitely one that they want to help you out with. The range, if you take the money out from January 1 to December 31st, 2020, this is going to be a penalty-free distribution. You will have to pay taxes on it, but if you do pay taxes on it, they're actually going to give you an opportunity to pay those taxes over a 3-year period. So if say, for example, you get laid off, say you've got a job where you're making $150,000 a year, you're like, I need some money in order to be able to tie myself over. I go to my 401k, I pull it out. So I will have effectively, say, you made all the way through March, well, so we'll say April, so it's like 1/3 of the year, so you may have gotten $50,000, you pull $100,000 out, you're going to have $150,000 of taxable income. That can cause some financial strain in and of itself also. So the IRS, Congress passed the law that basically said, look, we're going to let you take that distribution and have it taxable over a 3-year period. And I've seen this happen before. I remember when they were trying to really encourage people to move from traditional 401ks and traditional IRA plans over to Roth IRAs. And one of the ways that they ended up doing that is they said, hey, look, what we're going to do is we're going to grant you an opportunity to take, we'll do the rollover, and instead of being taxed on it all in 1 year, so it would jack up your tax rates and then have your marginal tax rate go through the roof, we're going to let you take that over 5 years so that you can get that done. So what I'm saying is that there is a mechanism for them to do this, and so I think the IRS should probably be able to implement this pretty smoothly. I'm not overly concerned about that. I mean, it'll take a little bit of rework on some of their forms, but there's a way to get that done. I'm not worried about that. The IRS is also working on further guidance if you need to return the money. So say, give you another scenario. you're making $150,000, you get laid off from your job, you decide that you're going to need to take some money out in order to survive. You take out $100,000 because you think that you're not going to be employable anymore. 6 weeks after you take the distribution, all of a sudden somebody's offering you a job. You can take some of that money and put it back. Now, how that was going to work and the mechanisms behind it, I have been looking for that. The IRS hasn't really put that out quite yet. My thought would be is that if you took $100,000 out, you put $100,000 in, there's probably not going to be any issues. You want to talk to your CPA, your EA, or your tax attorney, but more importantly, you also want to talk to your financial planner and let them know about that so that they can get that worked out for you as that needs be. There's also going to be a waiver of required minimum distributions. So if you are 70 and a half as of the end of 2019, you were scheduled to take an RMD in April, you're not required to have done that. And so they're going to go ahead and they're going to waive that from you this year. Basically, any RMD that has to take place during 2020, they're going to go ahead and they're going to waive that requirement for people to take. Again, this is one of those things that I think that, that they want you to have flexibility in managing your finances during a pandemic, and so as a result of which they're going to have these various things that they're going to do for you, which is a good thing. And I think somebody once asked me, if you had to summarize the CARES Act, what would you do? Well, I mean, how would you summarize it? I would say flexibility. It delivered a lot of flexibility to people so that they can better manage their financial situations as individualized to them, which, for most of my clients, that's how they want things done. They're just like, let me make my own decisions in order to be able to figure my stuff out. I don't want this becoming a political video, whether they were right, wrong, or indifferent on it. But the fact of the matter is, I think that if I had to characterize the CARES Act, I would say it was a flexibility bill. So, and that's how it ended up being. Another change that they did is that the charitable deductions. Now there's this, they actually did quite a bit of good stuff. So one of the problems that we've had in our firm as with many of our clients, because of the $10,000 limitation on the deductibility of state and local taxes, and as a result of them, many of our clients are already mostly paid off with their houses. And so as a result of which, most of them got kicked out of itemized deductions and moved over to standard deductions, which caused an issue where charitable deductions were no longer as valuable to them as a tax deduction. Now, most of my clients said, I don't care, I'm going to donate money as I see fit because I'm just doing it out of the goodness of my heart. But one of the things that they did to sort of improve charitable deductions is that they do now have an above-the-line charitable deduction. Now, according to the rules, it says $300. Now, does that mean $300 for everybody? So married filing joint, you get $300. Single, you get $300. Head of household, you get $300. Or are they going to do it where they're going to say, hey, look, married filing joint, you get $600. Everybody else gets $300. That I don't know. That I've not seen any clarification on that. I would expect clarification on that to be made as we get closer towards that year. There's also an entire possibility they could do some clarification and some follow-up legislation, because I know there has been some talk about this. Another one and this doesn't really affect too many of my clients. The 60% income limitation no longer applies if the donation is made to a qualifying charity. Most of my clients who are still working, the thought of giving away 60% of their income just wouldn't happen. Now, many of my clients, though, who are retired, this can happen very quickly, especially if they know that they're coming towards, the terminal part of their life. Sometimes the first thing they want to do is they want to give away everything they can. What ends up happening is that the IRS says, look, if you do more than 60% of your adjusted gross income, anything above that 60% has to be carried on to following years. And so, there's that can cause, it can cause some people to probably say, maybe not. To be honest, none of my clients have ever asked me about any of this. I don't anticipate this is a major issue for a whole lot of people. Probably the only time that I've even thought about this limitation, I had a friend of mine and I were sitting down talking one time, hey, if we ever won the big lottery, what would we do? And he had said that he wanted to give 3/4 of it away. And if he had given 3/4 of it away, he could have run up against a 60% income limitation. Now, I know he wasn't doing it for taxes. He was doing it because he just was like, and I think at that time it was around $300,000. He's just like, I don't, $300 million. I just don't need $300 million. I only need, he's like, I just need a nice, cool $50 million in order to be able to live. I can give the rest of it away, or whatever number he ended up coming up with, and from that, I think that there would of course be some limitations on that now. It carries forward. You're not going to lose it forever. It's just that you're going to pay some tax now, but you're going to get the deduction later on. I don't think it's a big deal. Another thing, and this actually is a big deal for C corporation owners. C corporations traditionally are limited to 10% of their taxable income as a charitable deduction. So, say for example, you have a corporation that makes $500,000. And they decide, hey, life was really good this year. We're going to give away $200,000 of it to a local charity. What would happen is the $500,000 times 10% for $50,000. They would basically say, okay, well, you've got the $50,000 that you're able to take, but anything above that, you're going to have to go ahead and roll it over into follow-on years. They've actually increased it to a maximum 25%, and there's some rules that have to be put into place here. So if you're a C corporation, you're thinking about doing some charitable deductions, go ahead and send us an email, or if you want, talk to your CPA, EA, or tax attorney, and they'll go ahead and get that taken care of for you. All right, so another thing, and this is kind of near and dear to my heart, student loans. I just had my student loans all paid off, thank God. But I know there's a lot of people who, they rack up a lot of student loan debt in order to become professional, especially in the accounting industry, where a master's degree is pretty much required to be a CPA in these days now. So what'll happen is that if the employer wants to offer it as a form of payment to the student that says, hey, look, we'll make a payment towards your student loans. The IRS has allowed that you can make a payment for student loans up to $5,250. Now, that $5,250 also has to be blended in with all the other education benefits that's potentially possible. So if you're providing education benefits to somebody, you can't do the student loans on top of that. It's $5,250. Now, what's the effect? Corporation still gets or company still gets the deduction for making the payment, but the student with the loan doesn't have to pick that up in income, and so that can actually be very helpful as a retention tool. Say, hey, look, stick around here. We'll pay you $5,000 for your student loans. There's probably a lot of students, recent graduates that would jump on that pretty quickly. The payment does have to be made before January 1st. So if you are a corporation or a partnership company or whatever that has employees, and you say, hey, look, I want to take care of my guys, I want to make this payment, you have to make it before January 1st. So you want to make sure that gets taken care of. Okay, so and then finally, in the realm of healthcare, telehealth is now covered under the high deductible plans. For a long time, telehealth wasn't covered. I think that because of how readily easily contracted this disease is, having people do it from home and having a telehealth, I think it just makes a lot of sense. And quite frankly, I think they should have done this years ago. I actually know somebody who had contracted the AIDS virus. She had a compromised immune system. I know, my father is a non-Hodgkin's lymphoma cancer survivor. They usually have compromised immune systems during the time that they're fighting the disease. I know a few of my other friends who have also gone through non-Hodgkin's lymphoma. This is something that, in my personal, going to a doctor's office for those individuals, I think is a deadly act. This I think just makes a lot of sense, and it doesn't. This is not one of those things that they put in the bill and said it's only coverable for like the next year. They put it in, and it's not reversal. It's not scheduled to be sundown. So that's a good thing. It'll be continued on for the foreseeable future. Finally, non-prescriptions are now covered for the HSAs and the Archer Medical Savings Account. So if you have an HSA and you want to use it to purchase some non-prescription drugs, that's allowed. And a very common one that I was thinking of here, a very common thing about COVID-19 is that you get a fever. So sometimes doctors may recommend that you do some fever control, and that could require that you go, get some acetaminophen or Motrin. Again, I'm not a doctor. I'm not suggesting that you go do this. And if you have any questions about your health, go talk to a doctor. That's not my swim lane. But I'm just saying that there are a lot of non-prescription remedies that could be used to help people that in the past wouldn't have been covered under these plans, but now it is covered. So that's actually a very good thing. So anyways, that's all I got. I wanted to say thank you very much for joining me for my first live move. I can imagine that a good majority of people are probably not viewing this live. We're kind of testing this out and seeing how this works out, and we're looking forward to it. If you have any questions, you can feel free to reach out to me. Once again, my name is Kevin Matthews. I am the tax professor. I want to welcome you back to class because the learning never stops. Thank you very much.